What's up, everybody? Welcome to the Stocks channel. My name is Cory, and this is going to be your stock market technical analysis weekend update. Now, for this weekend update, I wanted to do a little bit of speculation and education before we get into the stock market technical analysis. So I think if you watch the first half of this video, you're going to learn a lot about where the stock market could be heading. And if you're not interested in the speculation and education portion of the video, you could skip right through it and get to the technical analysis in the second half of the video. But first up, before we get into it, you know what you gotta do. Go ahead and smash that like button and subscribe to the channel so you can follow along with all of my updates. Now, first up, we're looking at the ticker symbol SPY, which is our SP500 ETF. So let's go ahead and crack open this chart and see what's going on in the stock market today. All right, so to understand what I'm about to show you, you need to have a general understanding of Elliott wave theory. So Elliott wave theory says that the stock market moves in a 5-wave pattern, such as this, where the market will move up in an impulsive move, have a correction for wave 2, move back up and resume the impulsive move for wave 3, have another correction for wave 4, and then ultimately finish out that move with a wave 5. Now, after a 5-wave of Elliott waves, you would have an ABC correction where you would get this A move down, a B move bounce, and then another move down to the C move. Now, to understand where we're going to go with this speculation in the stock market, you have to understand that there is smaller cycles of Elliott wave and very larger cycles of Elliott wave. So this graphic does a good job explaining that, and right here you can see that there's a 1, 2, 3, 4, 5 A, B, C, followed by another 1, 2, 3, 4, 5 A, B, C, and then another 1, 2, 3, 4, 5. Now this 1, 2, 3, 4, 5 waves of Elliott wave make up one wave of Elliott wave analysis on a larger scheme. Now, to show this, I will switch colors, and these 5 waves have now formed a new wave 1 on a much larger scale, where you will see it look like it's just one move to the upside if you zoom out from like a daily chart to a weekly chart, for example. So now the cycle would break up into a larger cycle where you would then get a 1, 2, 3, 4, 5. So then you look like you're going to a more macro level view of Elliott wave analysis, even though you have these micro moves where you still have these smaller 5 waves and ABCs inside of these bigger moves that are forming the same exact pattern. So hopefully that makes sense, and you're going to need to understand that to understand the next part of the video. So if you need to rewatch the explanation, go ahead and do that until it makes more sense, and then go to the next part of the video. Okay, so now we're back to the S&P 500 SPY ETF, and we're going to switch over to a weekly chart so we can see more of a macro level view for Elliott wave analysis. And if we zoom out and we go all the way back to 1993, we're going to go ahead and we're going to call this the larger scale wave 1 for Elliott wave analysis. Now, we did get that A, B, C correction, and that completes the corrective wave 2. So we're going to draw the wave down, and we're going to label the bottom here in 2009 as wave 2. Next up, we would have to say that we're going into this large wave 3. So we move up into wave 3, and we would expect wave 3 to end somewhere that is a Fibonacci extension level of wave 1. So we have that here with our 2.618. And we're going to measure that move and see where it ends to see where we would expect to see wave 3 end in this larger Elliott wave analysis. So now that we know we're in wave 3, let's go ahead and draw this out. We have wave 1, wave 2, and we're going to have wave 3 coming all the way up to a 2.618 Fibonacci extension of wave 1. Now, if we assume that the wave 3 will end at the 2.618, we're also going to assume that we get a 0.236 pullback to complete wave 4. Now, wave 4 could go lower or it could go higher, but we're going to go ahead and make an assumption here that we're going to at least see a 236. Now we would resume this uptrend and we would go somewhere up here to a wave 5. So why is this significant, and why are we speculating about a larger 5-wave Elliott wave analysis on a super cycle? Well, check this out. It just so happens to be that a wave 3 from the impulsive wave 1 brings us right up to about $360. Now, the highest price we saw on SPY this week was a high of $358. Now, we missed that target by about $2. So yes, we may have seen that price target met, and we could be in that large corrective pattern right now, or we could just be doing a minor cool off before we ultimately resume that super cycle and get up to that 360 level before we start down into wave 4. So to see this, we have to switch back to a daily chart, and we have to now understand at these levels, we have this red line up here, which represents that 360 price level from that wave 3 and that super cycle of Elliott wave analysis. And we are finishing our 5 waves that we're currently in now on a smaller scale. So we had wave 1 down to wave 2, up to wave 3, down to wave 4, and now we think we're completing wave 5. So remember, this is a smaller Elliott wave cycle and a larger Elliott wave cycle that we've been in for multiple decades now. So because we're completing wave 5, we are expecting to see that ABC correction. And right now we have yet to see where A is going to end. But we could assume that we saw A go down to the 0.382. Now we would expect to see that bounce. And then ultimately we would expect to see further move to the downside to complete wave C. Now we could also assume we're going to pull back into this 0.236 area and close these gaps. But we also had that level where we said on a super cycle to complete wave 4, we would come all the way down to this 236 level of the super cycle. So if we go back to a weekly chart, that brings us all the way down to a 290 price target. So it is very possible that we see some sort of complex pattern and ultimately see this sideways moving market that we really start going nowhere, but ultimately start heading down and get closer to this 0.236 retracement level to complete wave 4 of a super cycle. So there's a lot going on in the stock market right now. And if we did see the top of wave 3, we could see a larger correction for that super cycle wave 4 that would bring us down into the 290s. Now, another odd thing about the 290 area is we still do have this gap open from 515 where the price action jumped up and created this large gap and never actually got filled. And we do know that gaps typically get filled in the stock market, especially with an ETF like SPY. And we do see that that Fibonacci retracement level for that correction of that super cycle wave 4 could actually bring us down into the 290s. And while we're there, it wouldn't be surprising to come down a few dollars more and close this gap at 286. So on a short-term scale, I do think we're seeing this ABC correction playing out, and that's why we did see a continuation of the selling in today's price action. But we do need to expect to see that bounce and that further continuation to the downside to complete wave C. At that point, it could be possible that we come back up and meet our 360 price target that we have from the super cycle. And then after that is met, we could then go into that large correction where we would see a much larger ABC move. And within here, we would have smaller Elliott wave cycles that we would move down in 5 waves. We would correct up in 3 waves, and then we would move back down in 5 waves to complete the super cycle wave 4 correction. Now, if this is confusing you, I totally understand, and feel free to skip past all of the speculation if it's not your cup of tea or it's not making sense. But I do think we're going to see this play out in the stock market. And I'm becoming a stronger and stronger believer that we are seeing a significant temporary top in the stock market before we ultimately see that wave 4 correction and continue wave 5 to see buy levels maybe up into the 400s, 420 levels. Now that could take many years to play out, and we're talking this could be over the course of 3 to 5 years for all of this to actually play out and see the end of that super cycle. So right now we're going to call an end to the speculation, and we're going to get back into the technical analysis that you're here for. So right now we're still looking at SPY to come down and go into this 3-wave correction. And we did see a very interesting day today because we did see a continuation of the sell-off, but we did have a very sharp pullback and ultimately came back up and bounced and closed right on that 20 simple moving average. So while I know it doesn't feel bullish and the stock market selling off doesn't remind you of a bull market, but you have to stay objective and you have to look at the price action and you have to look at the trend. So when we look at the price action closing above the 20 simple moving average or right on it, that is still a bullish trend. We're still right on that 20 simple moving average, and we still have that trend of the 5 EMA trading above the 13 EMA. So while 2 days of sharp selling don't necessarily feel good on your portfolio if you're long, it could be likely that we saw the bottom for now and we're going to get that B bounce before ultimately seeing that C to the downside. Now, it would be interesting if the B bounce came all the way up and hit our 360s and then we saw the C wave and then ultimately got into our larger waves of correction, because anything's possible in the stock market right now. So another thing I want to do is we do have an update on our bearish versus bullish survey, and we do actually see an increase in bearishness from last week. Now, the historical average for bearishness is 30%, and we're actually going higher than we were last week, and we're back up to about 42% bearishness. Now remember what I said about that. The smart money knows retail investors are scared, and the smart money doesn't normally do what you would expect them to do. So if the majority of retail investors are bearish, which they are because we see 42% are bearish and only 30% are bullish, that means the smart money may want this market to melt up a little bit longer to pull as much money off of the sidelines into the stock market as possible, so that they have more selling to do and more higher prices that they can sell at to maximize their profit. Remember, smart money isn't obvious what they're going to do. That's why we look at the technicals and try to derive what the smart money's doing by watching what the price action and the trends are doing. So I'm a little shocked to see this survey do this. I thought we would see more people become bullish, but that is not what we saw. We actually saw less people become bullish, and the historical average of bulls are usually 38%. So we're still about 7 to 8% lower than the historical average for the bulls. And that tells me there could be some more upside in this market yet. Now, that doesn't mean the selling won't continue, because we could still see more selling before we get a bounce. That's why we really don't want to try to catch a falling knife. But right now, we do see a little bit less volume today, but ultimately we did see a day of selling on increased volume, because if you zoom out here, you can see that the volume was not trading at these levels during the uptrend. So we are still seeing a little bit of a bearish sell-off with the smart money possibly taking some profits up here, but we still do have that bullish trend and we still do have that bullish price action. Now, Tuesday is going to be an absolute critical day to see what happens, because we would expect to see a lot of volume return to the stock market after the Labor Day holiday. A lot of traders are going to come out of hiding, and summer will be coming to an end. And then in the fall, we normally see an increase in volume and we will see more trading. And that'll tell us what the stock market's going to do, because we're going to see more volume and more price action. And we could see if these trends are going to resume to the bull side, or if they're going to start break down and showing signs of a bearish trend beginning. So right now on the S&P 500, we're still watching this bullish trend to see if it's going to reverse, and we're only a day or two away from knowing if this bullish trend is going to end. But I'm still depending on that ABC correction. So ultimately, once we see that bounce, we'll know that the A wave's been complete, and then we could expect to see a further move to the downside once that B wave bounces and we continue down. So right now, I'm giving the highest probability to coming down and closing these gaps around the $327 level. Now, we're not going to get there instantly. It's probably going to happen like this, where we have a down move, a bounce, and then ultimately come down and close the gaps. And then I think we could resume the upside and get up into the 360s like the super cycle is predicting. So we're going to continue to watch the S&P 500 for these trends to play out. And we're going to keep a grand scheme picture on that super cycle. And we're going to put that in our back pocket for a potential possibility. In any event that we start seeing significant selling, we will know those corrective levels on a grand scheme of things. And we'll know something that other people may not know in the stock market who aren't paying attention to a multi-decade trend. Next up, let's jump over to our Nasdaq 100 ETF. And we're looking at the QQQ ETF, or the triple Qs. And we see the Nasdaq 100 had a huge day of volatility, coming all the way down to about $272 before ultimately closing way up here at $283. Now we still see the same thing on the Nasdaq 100 triple Qs, where we closed above the 20 simple moving average, and we still have that 5 EMA trading above the 13 EMA. So remember, that bull trend is intact as long as that 5 EMA is above that 13. We've seen that bull trend remain during this entire rally, that 5 EMA staying above that 13 EMA, and the price action finding support at that 20 simple moving average. So today is no different. It's just more volatility. And volatility is there for a reason. It's there to shake out retail investors and get them to panic sell. It's no surprise that the smart money wants to ramp up the volatility at the same time they're trying to profit take, because they want to be able to exit at higher and higher prices. They don't want to just dump their position all in one day, because they'd be selling at lower and lower prices and they'd be making less money on their profit taking. So the stock market is not designed to make sense and be rational. It's there to confuse you and trick you so that you lose all of your money and the smart money gets all of your money. There's not a lot of profit that is actually made in the stock market. It's usually just somebody losing money and another person earning that money. It's basically money moving hands, and there's not a lot of new profit or new money being formed in the stock market. So if you're losing money, there's somebody on the other end making money. So right now we still have to wait and watch this Nasdaq 100. It's doing the same thing as the S&P 500, where it's still in that bullish trend. It's just getting more volatile. Volatile is completely normal for the stock market, and if you're a trader, you should love volatility, because there was a lot of opportunity today. Just look, from the high of this wick to the bottom of this wick was a 6% swing in today's price action. If you were day trading any of that, you could have easily scalped a 2 to 3% trade because of all the volatility. Now, I don't recommend day trading, and if you're not good at it, probably don't try it, because most day traders lose money. Now look at the Nasdaq 100. We did see an increase in volume on a down day, and that is still a bad sign. We don't want to see an increase in volume on selling days if we expect the stock market continue to grind higher. But I still do expect to see that ABC correction, so we're still waiting to see when we're going to find that bounce and ultimately resume to the downside before resuming our upward trend. So overall, a very interesting day in the stock market, but we still need to watch and wait to see if this bullish trend is going to come to an end, and we'll know when that 5 EMA starts crossing below that 13 EMA. So next up is the Dow Jones Industrial, and we are looking at the DIA ETF here, and we see the same exact story on the Dow Jones. None of this is coincidence. There's algorithms and bots trading these indices to make sure these things happen the way they do. And we do see the Dow Jones came down and blasted through this gap today, so we can go ahead and delete this gap, but we still do have 3 more gaps below us. Now we also see on the DIA Dow Jones ETF, we closed right on the 20 simple moving average, even though we went as low as $277, but we ultimately closed up here around $282. Now we still have that 5 EMA above that 13, so that bullish trend is still intact, and we're still trading above that 20 simple moving average. So I would go ahead and call that shenanigans in the market, and they're totally playing games with you, and that's why we call them smart money. If they were dumb, it would be too predictable and everybody would be able to see it coming. So let's jump over to the VIX, which is our fear indicator, and we see some more weird stuff going on with the VIX because we actually saw the VIX go down 8.5% today, even though the stock market went down. So the VIX is actually doing opposite day, where the VIX is going higher when the stock market goes higher, and now the VIX is going lower when the stock market goes lower. If that's not playing games with your mind, I don't know what is. But ultimately, we still have a very bullish trend on that VIX, and we still have that 5 EMA getting more aggressive to the upside and almost going parabolic, trading well above that 13 EMA now. So the VIX is still showing that that fear is not ready to leave the market, and the bullish trend is only getting stronger on the VIX. So I wouldn't be surprised to see a couple of days of cool off on that B bounce and that ABC correction, and then ultimately see another huge spike in the VIX on the C wave down. But right now we still see the VIX looking very bullish, which means fear is probably going to continue to come into this market in droves. And I would think the smart money is going to try to shake out the retail investors and get them to pull some cash off the sideline by tricking them into thinking that that bull market's going to resume, before ultimately trapping them around a SPY level of $360 before dumping their positions yet again. So the VIX is kind of telling us a story, but you have to understand what the VIX is to understand how that story is going to play out. So next up is the financials, and we do see the financials still trying to peek their head outside of this consolidation wedge and continually getting whack-a-mole back into the wedge. So this 200 simple moving average is still acting as resistance for the XLF financial ETF. However, we do still need to wait and watch if the financials are going to break to the bull side or the bear side. I've been saying this and I will continue to say it. If financials break down to the bear side, the S&P 500 is done for the year. We're not going to see the S&P 500 break to new all-time highs if financials are going into a bear market. We see that financials have lower highs and higher lows, which tells us we're in an unknown area where we're in a consolidation pattern, and we need to see whether it's going to become bullish or bearish. So we're not going to guess, we're just going to wait and watch the financials and let the price action tell us if it's going into a bull market or a bear market. Next up is the industrials, and we see the industrials actually looking pretty good today, holding up above the support trend line and actually closing above the 13 EMA as well as the 20 simple moving average. So the 5 EMA is still trading above the 13, so we still have that bullish trend and we still have that bullish price action on the industrials. We also see the industrials closed up a little bit higher today, even though the rest of the stock market was down. So we see financials and industrials showing a little bit of strength today, but industrials do have that higher high form, so they are definitely the more bullish sector right now. Next up is healthcare sector, and we see healthcare looking the worst of them all, with healthcare having that 5 EMA cross down below the 13, as well as the price action closing below the 20 simple moving average for 2 days in a row. Now that is a very bearish sign, and we are starting to see some of the sectors show weakness, with healthcare leading the way. So if financials break down into a bear market, and we have healthcare also breaking down into a bear market, we're going to start getting lower highs and lower lows, and that's going to tell us that the S&P 500 is done for the year, and we're not going to see new all-time highs to end 2020. So we could be in the start of that huge wave 4 correction cycle, and we could be in that large multiple year correction where we're going to see a sell-off or a sideways move in the stock market for the next year or two. It's still way too early to say that, but this is definitely a warning sign to see the healthcare sector breaking down and showing a lot of weakness. Even though the other sectors are still holding up as a bullish trend, it's still too early to say if that bullish trend is going to hold up because we're still in a falling knife situation. In a falling knife situation, you don't want to try to catch the knife. You want to wait and you want to watch for that bounce. And you want to make sure you're not buying it just because it bounced, because it could also just be a dead cat bounce. Even a dead cat bounces if you throw it hard enough at the ground. So really, we're waiting for that ABC correction to play out, and we're going to see if the stock market is going to resume in a bullish momentum trend or if it's going to start breaking down and showing signs of a bear market. Next up is the US dollar, and we're looking at DXY, and we see the US dollar went up about 0.21% today. So this also doesn't seem that surprising because we're seeing the dollar strengthen around the same time we're seeing the stock market go into a correction. And that's exactly what we would expect. As the dollar gets stronger, these asset prices need to cool off because they're so inflated. Now, when the dollar was getting weaker, these asset prices were inflating, which made sense. But if we're seeing strength return to the dollar, we need to see the stock market and these other assets continue to correct. But right now, we still have lower highs on the dollar, and we're waiting to see if the dollar can break out above this resistance trend line and ultimately form a higher high. That's going to be some great information for us to know and ultimately know if that stock market's ready to go through a larger correction or if the dollar is just having a technical bounce before resuming its downtrend. So we're just a couple of days away from knowing if that dollar is going to continue to show strength, so we're going to continue to watch it. Next up is gold, and we do see that gold broke out of our consolidation wedge, and it was looking like it was ready to go on a bull run, but it's really just taking time now to come out and test its support level, and we are seeing a little bit of a bounce. So if we could see a continuation of this bounce, I would look for gold to come out here and test this 2000 level and see if gold's going to get rejected at 2000 and resume a downtrend, or if it's going to break up and form new all-time highs. So right now, gold's at a very good support level, and these are the best levels you want to look for trades because you know your risk is right below support. So do what you will, but gold looks like a great trade right now, especially if it's going to break out into a bull market. Now would be a great time to start considering adding some gold into your portfolio. So let's take a quick look at our FOMO stocks, and first up is Apple, and we see Apple actually closed about flat today, even though it had a very volatile day. And we saw it come down looking like it was wanting to close this gap here, but ultimately bouncing and closing up higher for the day. Now, Apple also closed right above that 20 simple moving average, if you can see it there. And we do still have that bull trend with that 5 EMA trading above the 13 EMA. Now, we still have to give benefit of the doubt to the falling knife pattern that we're seeing in the stock market indices. And I would not be jumping into Apple right now when we still have these two large gaps below us. So we'll see if Apple can hold up around its 20 simple moving average and resume that bull trend, or if it's just in a technical bounce because it was being oversold from the previous 2 days of selling. Next up is Tesla stock, which is our other FOMO stock. And we see Tesla had something very similar happen today where it went down well below the 20 simple moving average before ultimately closing up higher. Now, Tesla did close above its 20 simple moving average as well, but it did get rejected right here at the 13 EMA, which could be a warning sign that we're going to see a continuation to the downside. So right now, I would not be a buyer of these FOMO stocks. I would wait a week or two and let them see how they're going to play out and let them go through that stock market correction before ultimately seeing if they're going to resume their bull trend. Just a quick update on Bitcoin. It did have a breakout and form this new higher high back in July, and it is testing that area of support and bouncing. So gold and Bitcoin seem to be finding their support levels and holding up, which is kind of interesting because it's telling us maybe the dollar will continue to weaken and maybe the dollar is just in a technical balance and it will continue to go down after this trend continues. So going back to the S&P 500, we're looking at a possibility that we ended the fifth wave of this Elliott wave and we're going through that ABC correction, but we're also looking at the possibility that we're in that super cycle wave 3 where we could get up to 360 before ultimately coming down all the way to 290 and possibly closing this gap at 286. Now remember, this is the weekend update and we don't normally speculate on what the stock market might do, except on the weekend we're going to do a little bit of speculation because one, I think it's interesting, and two, it could actually play out to have some significant impact because we can't deny the fact that we're in a multi-decade cycle and this stock market has been bullish since 2009. So it'll be very interesting to watch it play out. And I wanted to throw that into this weekend's video to give you all something to chew on. So really start thinking about, did we just see a very critical top in the stock market? Or are we about to see a very critical top if we get to 360 on SPY? And then ultimately, are we going to go through that huge correction where we could see a minus 20% sell-off in the stock market? over multiple months to end the year of 2020. I'm just looking at the charts and I'm looking at the possibilities, and right now that is a very possible situation. So just a reminder, everybody, the VIX is elevated in the 30s, so you're going to continue to see these crazy swings in the market. So if you're not sure what to do right now, your best thing is to do nothing and wait and watch for these trends to play out. And let's see the price action and the trends tell us where the bottom's going to be before we ultimately buy back into this market. And if you're trying to short this market, you also need to be careful because we've had two massive sell-offs in a row now. And that sell-off could easily go back to a bullish trend and you could lose your shirt trying to short right now because we've already had two massive down days. So if you're a rookie trader or you're still learning the ropes, maybe your best bet right now is to do nothing and just follow along on this channel until you see some evidence that we've seen that correction end and we're ultimately ready to go back into a bullish position. So good luck out there, everybody. If you like this video, please help me out by smashing that like button. I really hope these videos are helping you guys out. And remember to subscribe to my channel so you can follow along on all of my technical updates. Thanks for watching, everybody. And as always, I will see you in the next episode.